If you own real estate, there is a very high chance you are paying more in taxes than you need to, not because you made a mistake, not because your accountant is doing anything wrong, but because most property owners use depreciation in the most basic way possible. In this video, we are going to explain cost segregation step by step, what it is, why it exists, how it works in practice, and how real estate owners use it to improve cash flow while staying fully tax compliant. By the end of this video, you will have a clear understanding of whether cost segregation is something you should explore for your own property. When you buy an income-producing property, the IRS allows you to recover the cost of that property over time through depreciation. For residential rental property, that timeline is 27.5 years. For commercial property, it is 39 years. This means that, on paper, you spread your deductions evenly across decades. The problem is that buildings do not wear out evenly. Think about everything inside and around a property: lighting, flooring, plumbing, electrical systems, cabinets, parking lots, sidewalks, landscaping. Many of these components wear out much faster than the structure itself. Yet under traditional depreciation, they are all lumped together and written off slowly. This is where cost segregation comes in. Cost segregation is a tax strategy that allows property owners to break a building into its individual components. Instead of treating the property as one single asset, each part is identified and assigned its own depreciation timeline based on IRS guidelines. Some components qualify for 5-year depreciation, others qualify for 7 years, others qualify for 15 years. By accelerating depreciation on these components, you are able to claim larger deductions earlier in the life of the property. This does not increase your total depreciation. It changes the timing of when you take it. That timing difference is where the real benefit comes from. Now, an important question comes up at this point. Is cost segregation legal? Yes. Cost segregation is a well-established IRS-recognized tax strategy. It is not a loophole. It is not aggressive tax planning. The IRS has issued guidance and audit technique manuals specifically addressing cost segregation studies. When done correctly, it follows existing tax law and accounting principles. The key phrase there is done correctly. A proper cost segregation study is not just a spreadsheet or a guess. It is an engineering-based analysis that documents exactly what components exist in a property and why they qualify for accelerated depreciation. Let's walk through the process step by step. The first step is a property review. At costsegregationguys.com, this starts with gathering basic information about your property. Things like the purchase price, the date of acquisition, the type of property, and how it is being used. This information is used to evaluate whether cost segregation is likely to make sense for your situation. Not every property qualifies, and not every property produces meaningful savings. That is why this step matters. Based on this review, a proposal is prepared. This gives you an estimate of potential savings and study costs before you commit to anything. This allows you to make a decision based on numbers, not assumptions. If you move forward, the next step is the engineering-based study. This is where the real work happens. Specialists analyze the property in detail. They review construction documents when available. They examine building layouts. They identify components that qualify for shorter depreciation lives. This includes items like interior finishes, wiring, lighting systems, plumbing, and certain structural elements. It also includes site improvements such as parking areas, curbs, sidewalks, and landscaping. Each identified component is assigned a depreciation life based on IRS rules and case law. The goal is accuracy and defensibility. Once the analysis is complete, the results are compiled into a formal report. This report is IRS compliant and designed to support your tax return. It includes detailed asset breakdowns, cost allocations, and depreciation schedules. It also includes documentation that helps support the study in the event of an audit. This report is then shared with your CPA or tax professional. Cost segregation is not a replacement for your accountant. It is a tool that works alongside them. The accelerated depreciation is applied to your tax return, often creating significant deductions in the first year. For properties purchased in prior years, cost segregation may still be available through what is called a catch-up depreciation adjustment. This allows you to claim missed depreciation without amending prior returns. Now let's talk about why real estate investors care so much about this. The biggest benefit of cost segregation is cash flow. When you accelerate depreciation, your taxable income goes down. When taxable income goes down, taxes go down. When taxes go down, more cash stays in your business. That cash can be used to reinvest in additional properties, to pay down debt, to improve existing assets, or simply to improve liquidity. For many investors, the tax savings in the early years of ownership far exceed the cost of the study itself. That is why cost segregation is often described as a timing strategy. You are not creating deductions out of thin air. You are moving them forward to when they are most valuable. Cost segregation is commonly used by owners of rental properties, apartment buildings, office buildings, retail centers, industrial properties, and even short-term rental properties in certain cases. It is also used by both small investors and large real estate groups. What matters most is property value, property type, and tax situation. Now, a common concern is cost. A cost segregation study does have a fee. That fee varies based on property size and complexity. However, the right way to look at cost segregation is not the price of the study. It is the return on investment. A well-executed study often produces tax savings that are many times higher than the cost. That is why the first step is always a review and proposal. You should know what the potential upside looks like before moving forward. If you are curious whether cost segregation could benefit your property, the smartest next step is to run the numbers. CostSegregationGuys.com offers free proposals so you can see potential savings before making a decision. There is no obligation, just clarity. Understanding how cost segregation works puts you in control of your tax strategy. And for real estate owners, control over cash flow can make all the difference. To learn more or request a free proposal, visit CostSegregationGuys.com.